Hello, this is Si Wing Yi. I'd like to take this opportunity to share with you how to calculate cash flows and actually the three numerical metrics that all investors need to understand. And they are rent to value ratio, capitalization rate, cash on cash return, and total return on investment, which is total ROI. So I will do my best to clearly, concisely, simply to explain this so investors can make an informed decision. So let me start off by saying the benchmark, okay? The minimal benchmark to achieve a positive return, for example, cash flow situation with a 20 to 25% down payment, for example. So the rent to value ratio is ideally around 1%. 1% of the purchase price, 1% multiplied by purchase price, for example, 100,000. That means the monthly gross income around 1,000. So this is a benchmark. So if you can achieve this ratio, then you're going to have a positive return. Then you can have a positive cash flow based on financing a purchase. So, so 1% is good, like 0.7%, 0.7 to 0.8 of 1% is also very acceptable. All right. So with that in mind, so the second metric is the capitalization rate. Capitalization rate is sort of technical. I mean, capitalization rate, the benchmark is around 5%, 5.5% capitalization rate. Then if you can achieve that, then you can also be able to achieve positive cash flow based on investor financing. And of course, and the benchmark, like I said, is 5%. If you can obtain anything higher than 5% capitalization rate, which is cap rate, once again, you're going to have a very good investment potential. And then third is the cash on cash return. And the benchmark for that is around, give or take, 10%. The cash on cash returns is based on you financing an investment purchase of a house, how many years it takes for you to recoup your down payment. So if it is a 10% cash on cash return, it means all the cash flow on an annual basis, the net annual cash flow, it will take you 10 years to recoup your down payment. Now, if the cash on cash return is 20%, for example, that means based on the first years of net annual cash flow on a finance purchase at 20%, in about 5 years, you're going to recoup your original investment, which is your down payment, whether it be 20 or 25%, depending on each situation. And of course, lastly, on total ROI, total return on investment, this is a very important metric. The total return on investment is your total first, at the end of the first year, your total net annual cash flow plus your principal reduction benefit plus your projected appreciation rate at the end of the first year. You combine all these three numbers and you divide that by your total out of pocket, which is your down payment and your closing costs, equals your total return on investment. The benchmark, I don't know, could be 20, 30, 40%, but in certain instances, you can achieve a lot more than that, sometimes 70 to 80 to 100%. That means at the end of the first year, your total annual net cash flow plus your total appreciation that occur at the end of the first year pretty much will divide by your total down payment, and that equals your total ROI, return on investment. All right. So hopefully you have a clear understanding. So with that in mind, let's go to an actual property. And this property is located in Ocala, Florida, part of our Central Florida opportunity introduction. So this is a new construction property. Is located in Ocala, Florida, which is 1 hour north of Orlando Metro. And this is a new construction. They are about to go into phase 2, which is a new construction, like I said, and the lot will be available to be reserved soon, a few weeks from now, hopefully. Then if you would reserve this lot, then allow for the completion of the property takes normally 4 to 6 months, right? So then everything will go forward beyond that. All right, so here are again, this is my disclaimer is that these numbers are projection based on past metrics and also based on future, projections. So it's not a guarantee, obviously, but it'll give you an idea of how we calculate this particular pro forma, if you will, or and all the numerical metrics that I described to you, which is critical. All right, so again, this property is a 3-bedroom, 2-bath, is approximately 1,300 square foot, and the listed price for our investors is $169,000, but the market value, the appraised value of this property is $175,000. So basically, when you reserve this lot, you basically have a walk-in equity, if you will, for about $10,000. We're talking, a little bit more than. So you buy $169 property, you have a $10,000 walk-in, so you have, I don't know, around 6% appreciation already. So when you purchase this property by reserving the lot, so you make your money when you buy, right? That we all heard that. And also, I also projected appreciation for the next 12 months. When you complete the property, is around 5% appreciation based on the trends and the research and data that we put together. But it is a very conservative estimate, right? I mean, that it could be higher, could be less, but I want to be conservative, all right? And then here it is. So here it is. So the purchase price, the list price is, like I said, is 169, and as you can see right here, hopefully you can see. All right, so I need a reading glass. So let's go on. And then your down payment at 20% down payment. You could do 25% if you wish, but most people rather do 20% down payment, assuming you qualify to get a loan. All right, here it is, which is total $33,000. Then the estimated closing cost is projected to be $4,000 plus loan cost another $1,000. So your total out of pocket is a little bit more than $38,000. All right, so that is your total at risk for this particular investment on a financing purchase. And then the projected rent based on previous track record this past year, 2020, the gross rent for this property is projected to be $1,500. All right. And then we're not going to put in any vacancy because we're not going to, when you close escrow, we will ensure that the property management will rent the place out before you close escrow. So we're not going to have any vacancy to your situation. By the way, the reason, because of the fast growing nature of this particular region, typically what we have seen so far is that whenever our investor close escrow on the property here in Ocala, Florida, what happened in recent past is such that there are 10, 20, 30 tenants that want to rent one house. So the tremendous amount of rental demand for this kind of product is very, very attractive beyond your expectations. So we're not going to put any kind of a vacancy factor for that reason. All right. And then several reasons why the cash flow is very, very attractive in this particular product is that the property tax. The property tax is like a little bit more than 1% of the purchase price. Okay, in this case, approximately $208 per month on a property tax, which is very, very good, which will give you a very higher cash flow than more normal. So in other states in the country, your property tax is more than 1%. And much to you, some of you are surprised, the monthly insurance for this property, because Ocala is located in Central Florida, is only $25 per month on the insurance coverage, which is amazing, right? And when you have a new home, the insurance coverage is less because you have exceeded the modern construction code that can protect any kind of adverse weather conditions. But in Central Florida, you're not gonna get that much. And of course, because you're part of our network, normally the property management fee is typically 10% of the rent. Because you're part of a network, you get a discount. So you get an 8% property management fee, which is $128 per month. All right. So, and note, another thing is, because this property in Central Florida, with the realty doctors we work with, Gene Gillum and Wagner Delasco, they built these homes in infill lots. That means they spread out the homes in throughout the neighborhood, so you're not in part of a community whereby you may have to pay a HOA, homeowners association. So there are no HOA, no homeowners association pertaining to this product. So again, give you another opportunity to increase your net monthly cash flow. And of course, we'd be remiss if we do not talk about the interest rate. I mean, we are at the historical interest rate environment. So very, very historical. It's just like free money. You're leveraging your property with free money, which is shockingly amazing if you do not take advantage of this favorable financing out there at the lowest interest rate for years and years, which is you have to take advantage of it. So I projected to be 3.5%. Could be very, very conservative. You could achieve less than 3.5% 30-year amortized fixed rate loan, which is amazing benefit. You can leverage. By leveraging your real estate investments, you're getting a higher return on your investments. That's pretty obvious. So 3.5% is when 20% down. If you want to put 25% down payment, I could make the argument that your interest rate on the loan could be as low as 3.1 to 3.2%. Of course, if you want to put 25% down, you're going to pay extra $8,000 or more. So you, instead of $38,000, your total down payment, including closing cost on a 25% down payment, could be like $45,000. On the other hand, just so you know, of course, I consulted my loan agent on a consistent basis. Our preferred investment loan agent is Mr. Richard Advani from Supreme Lending, and he said you could even put down 15% down payment on this single family home purchase, residential purchase. You have to pay a little bit of PMI, which is private mortgage insurance. And that is also very, is not that much on a monthly basis because the purchase price is so reasonable. So your monthly PMI additionally is only around $50. Okay, it's not that bad, right? So there's a lot of misconceptions around this. So yeah, if you wanna put 50% down to purchase single family home rental, I mean, the total out of pocket is only like $30,000, and that's including your $4,000 closing costs. Is it amazing? For 30 grand, you could potentially buy a below market value new construction in a very fast growing area of Central Florida for only $169,000 with a walk-in equity with a projection appreciation for the next few years could be higher than 5%, which is my projection. So, all right, so which is mind-boggling. The numbers are just off the chart. So with that in mind, this particular property, which is promoting, which is the rent to value ratio is 0.9, which is slightly less than 1%. You're not gonna find, okay. I mean, I would challenge you to find any new construction property, single family home that is in a very fast growing area, as it is here in Central Florida, for renting at almost 1% rent to value ratio, 169K property renting for $1,500. Please help me, challenge me if you can find any other new construction for this square footage, for this kind of A minus asset class location at renting for 1,500. I mean, let me know because I have not found it anywhere else in the country. All right. And then let me, so the rental value ratio is way above the benchmark for new construction homes. And finally, I mean, not finally, the next thing is I want to talk about the capitalization rate, which is in this case 8.8%. Is very significant. 8.8% is way higher than the 5% capitalization rate benchmark. So again, how do you calculate capitalization rate? Is you calculate the annual net debt obligations, okay, which is down here, right? Your taxes, insurance, property management fee, and all those things. You do, and you do not include the mortgage. So so the net of the annual debt obligations divided by the purchase price, in this case, equals capitalization rate, which is 8.8%, which is very, very extremely attractive, especially on a new build type of product. And then cash on cash return, in this case, is 20%. Again, is above the benchmark of 10%, which I told you about earlier. So how do you calculate this? That means at 20%, you can recoup your 38 grand of total out of pocket, your risk of the investment in about 5 years, right? 20%. In 5 years, it's going to be your annual net cash flow, okay? Your annual net cash flow, your monthly net cash flow is already a whopping $631. I mean, find me another property, a new construction in a best growing, fastest growing area among the tops anywhere in the country where you can buy for 169K, renting for 1,500, and with a great interest rate of in the mid threes or low threes, and net monthly of $631. Come on, this is amazing cash flow. So 631 multiplied by 12 months equals $7,578 annual net cash flow at the end of the 12 months, at the end of the first calendar year of owning this property. So 7,578 divided by the total initial cash invested, which is your down payment plus your closing cost of 38,800, equals 20% cash on cash return. You see? See the power of leverage of using your loan to buy investment property. And finally, total return on your investment in this case is 75%. I mean, at the end of the first year, total return on investment. I'll show you the calculation momentarily. I mean, with the stock market at the end of the first year, if you invest 38,000, right? Maybe you get 5 to 6% interest return on your mutual funds or stock market. What's 5% of 38,000? We're talking like $1,600 at the end of the year. That's your return on investment on our stock market or on a mutual fund. But what you're getting on this house with the leverage you can get on a loan, which you cannot get onto them. You cannot get a loan to buy stocks, right, or mutual funds, but you can get a loan to leverage the power of leverage using real estate. So 75%. I mean, this is mind-boggling. How do I calculate 75%? Easy. So I add the annual net cash flow, right, which is in this case 7,578. Then I add the principal reduction benefit, which is 2,500, right? You're paying down your mortgage. There's some intrinsic value associated with paying down your mortgage in the first year, which is in this case is another $2,000 something dollars per year. Then at 5% appreciation, right? 5% multiplied by 169K. At the end of the first year, projected appreciation, your house gain in value another 18,500, right? So you add the total annual net cash flow at the end of the 12 months, first year of owning this property. Then you plus the principal reduction of a couple of thousand. Then you add on the 5% appreciation rate. You add those three numbers. So your total number, we call it gross equity income, is 23,000 something. I can't see that well, right? See it right here? Then this number, 23,000 something, divided by your total down payment, total cash invested, closing cost, down payment, at 20% down, which is 38,000, equal $75,000 return on your investment at the end of the first year. All right, so I think that's pretty much it. I have stated my point. These are fairly realistic numbers because phase one back in last year, we have achieved this kind of return because it's a fast moving market. Florida is among the top in population and job growth with the mass exodus and the migration of people from New York State, New Jersey, and Connecticut primarily coming down to live in Florida as a result of the pandemic and all that. Plus people from California as well coming over to Florida to invest, to live, to play, to retire, and in everywhere else in the country. You see all the cold weather, freezing weather, Arctic cold blasting the Midwest and the East, Northeast, and and the Mountain West. I mean, who would not want to? People want to invest and live and retire in sunny Florida, right? With an affordable market, home prices, rental prices, you can achieve very high return. So again, I clearly stated what I need to state. All the four numerical metrics have way exceeded the benchmark, if you will, for investment properties. And so that's pretty much it. So if you guys are interested to pursue something like this, we have other locations in Central Florida that are promoted by our partner Gene Gillum and Wagner Delasco, right? Our network partner in Central Florida. They have other products in Palm Bay and Kissimmee, Poinciana, and in Sebring as well. And so they have great products, all new construction. This is a built to rent model, which is the fastest growing real estate asset class out there moving forward. So this is a big thing, built to rent model, where our builders and our network is selling new construction homes to investors only. So you don't have to overbid. You don't have to do multiple offers, bidding war with the open market. This built to rent new construction business model are allocated to only real estate investors such as our group. Okay, thank you so much for listening. Hopefully it is another great educational content. So if you need to look further, just consult with myself and my Central Florida team of the real estate doctors, and look forward to helping you guys. Thank you so much. This is Si Wing Yi from the Real Estate Network. Have a nice day. Bye-bye.